Everybody, Scott Callan from Ichigo. Thank you very much for joining us for our FY23 Q1 corporate presentation. I'm joined by Dan Morisaku, who's a senior member of our global finance team and the head of global IR for us. So let's jump into it. I'm going to start on page. Let's see, I've got paper in front of me too. I'm both analog and digital today. Hopefully, I need to get digital first. So page 8 shows the Q1 summary. And look, it's an incredibly difficult world out there, and I think it's probably a strength of the firm that, in large extent, it's not relevant to us. We just kind of run forward. Q1 was no positive or negative surprises, just kind of basically right on track. So the key elements that are on the page right here are we've been excelling acquisition of our sustainable real estate assets in both our multi-asset and our Ichigo owners business. The hotel recovery is well underway. And you can also see, though, how crushing the COVID impact has been, right? So year-on-year RevPAR, so that's revenue per available room, so a broad indicator of how productive our hotels are up 81% year-on-year. And despite that huge rebound, it's negative 43% versus pre-COVID. So there's a lot still to go. We are robustly climate positive. Our CO2 reductions, meaning we have a very significant, as you know, clean energy business that produces clean energy with no CO2 emissions, and therefore those subsidizing for CO2 creating fuels. We have substantial reductions, and they're well above our own emissions. We're also doing quite a bit of work to take down our emissions by transitioning in the so-called RE100 process to go 100% renewable energy by 2025. We've had 6 consecutive years of share buybacks. The total amount to 1.5 billion yen, or 8.4% of shares outstanding. That included a Q1 buyback that we did just over the last 3 months. Let's go to the next page. So this is kind of information we provide on an ongoing basis. We have experienced a significant COVID impact. We continue to experience it primarily in the hotel business. It's showing up in sustainable real estate in part of that, but on a year-on-year, we've gone down in terms of our stock earnings. So those are ongoing kind of, fixed earnings. Fixed is less fixed during a period of massive change, but these are very, very stable earnings. And what's happened here is primarily a Odaiba effect. As you know, we have one large office asset. Our experience has been that, and we only have one large office asset. Everything else we own is small and mid-sized office. Small and mid-sized office has performed extraordinarily well. And the one big office we've had is continuing experiencing vacancy. It's running at about 56% occupancy right now, and so that's pushing down our stock earnings and SRE, sustainable real estate. Asset management's down a little bit year on year. That's just kind of some fluctuations, and clean energy is flat. Going to the next page, as you know, we've introduced all-in disclosure to increase our earnings transparency. The issue that we need to solve for you to give you more transparency on our sustainable real estate business is that we have proactively used the tax shield of depreciation by moving our sustainable real estate assets as much as possible into fixed asset category. That's an accounting category, and a tax category. It doesn't change anything that we're doing in terms of adding value to those assets. But what it does mean is if you have those assets sitting in real estate for sale, you don't get the depreciation allowance that pushes down your taxable earnings, and so we move them into fixed assets. It gives us this tax shield. The result of that, however, is that when you do sales on these assets, they show up as extraordinary gains rather than in operating profits. And in fact, this is our core operating activity, and nothing has changed. So it's confusing to look only at OP in our case, because you're missing this huge contribution from our activity in the sustainable real estate business. So turning to the next page, you can see we show not only OP, but we show all-in OP and recurring profit RP and all-in recurring profit, just to give you more visibility. So the numbers are down on OP and all-in OP about 14% year on year. That doesn't really matter. That's just quarter-to-quarter volatility. Net income and cash EPS are down about 1%. Again, the same. It's probably most important to look at this page. As you can see, we do everything we can to preserve and grow cash flow. And so as you can see, our cash and net income is nearly twice what our stated accounting net income is. And that's the better indicator of how productive the business is. I mentioned we've done extensive buybacks. We will continue to do so. You know, the productivity that is generated for all of you as a shareholders or our cash returns are going to be delivered back to you with growth, EPS growth, either through growing the top line, meaning I suppose I should say the bottom line, growing earnings, or shrinking our shares outstanding. Page 12 shows the segment earning details. A little bit of a sloppy and muddy quarter because none of this looks particularly good. I mean, asset management's down 9% year on year. Sustainable real estate's down 15%. Clean energy is down 11. The clean energy is just kind of bad weather in some around some of our biggest assets. We've had, and this is March to May, we've had like extraordinarily good weather in June, meaning no rain, which is perhaps not good weather, except when you're running a solar business, and no rain is like really, really good. So this is all back. Asset management will come back, and we expect to see in sustainable real estate SRE everything coming back also. Turning to kind of the key elements of the business model, I'll go briefly over this because it's something we talk about on an ongoing basis, but it's important. So page 14 shows that we're a hybrid business. We have both stock, very stable earnings. On the top of that, we embed flow earnings. Page 15 shows what's happened with our stock earnings over time. As you can see, the green is the clean energy business that continues to grow. The major impacts that we've experienced have been the sustainable real estate. That's both a function of getting kind of absolutely crushed in a quarter of our assets, which are hotels, would have gone from being robustly profitable to money losing over the COVID period, and a decrease in buy-sell activity as kind of markets locked up. And the good news is the markets are clearly coming back in a very big way in terms of buy-sell activity, which is really, really good for us, predictive of increased forward earnings. Page 16 shows embedded forward earnings. This is what third-party appraisal says, or the unrealized gains on our balance sheet. And we have stated shareholder equity of about 98 billion yen. The third-party appraisers say we have another 65 billion yen on top of that. If you turn to the next page, you can see, in fact, in general, we get more than twice that. When we actually sell assets, we get twice what the appraisal, more than twice the appraisal value. And so it's a way of saying at this point, the company's trading at a substantial discount to NAV, despite kind of the ongoing productive business. I will point out that very unusually, and probably not to be repeated, in the first quarter, we had our actual gains on sales coming right in at appraisal value. We sold an asset in Ginza, which is like super, super prime retail. Given super prime retail, the appraisers feel comfortable in giving the super high evaluation. We actually bought it. We actually made substantial returns on this asset. We bought it at a 20% discount to appraisal value and sold it at appraisal value. So that's why you get the 1.0x. But going forward, you should expect kind of a 2x, 3x return from us on our sustainable real estate activity. Page 18 shows again the focus on robust cash generation. We consistently deliver kind of 2x our stated net income in terms of economic operating cash flow. 19 is what's happening with our financing. Rates have gone up everywhere in the world fairly dramatically, not nearly as much as inflation, of course, and not in Japan, and certainly not for us. So we continue to finance below 100 basis points. We've taken in the duration of our debt in part because Ichigo Owners, which is a kind of a less than 1 year holding period business, is an increasing part of what we do. You don't need 10-year debt against kind of a 7-month hold. 6 years of debt is more than enough, but we continue to borrow very, very long term in order to make sure that we don't have any problems with being able to ride out any negative market environment. I'll turn to page 21, where we speak to kind of where we're in terms of being climate positive. As you can see, we continue to grow our solar and wind production, which are non-CO2 emissive. That means that we're replacing CO2 emissions. So that shows up in the green bar as our CO2 reductions. At the same time, we're tackling our own CO2 emissions, both by increasing the share of renewables, which I'll turn to on the next page, and increasing our energy efficiency. So at this point, we have CO2 reductions at 2.5x our emissions, and that's structural and will remain that way. Page 22 in front of you shows our current renewable energy ratio, which we expect to get to 70% this fiscal year, and that's up from 53% to 60%, 7% just in the first quarter. I'll turn to page 24, which shows what's going on in terms of buy-sell activity in our sustainable real estate business. Probably the most important thing to point here, well, there are a couple of things that are going on that are very, very positive. One of them is that we have gotten better at acquisitions. We have under-acquired. I mean, this is a business. Sustainable real business it's a turnover business. We buy assets, we add value to them, we sell them, and at a higher value because we have genuinely added value to them. So we need to buy assets, and so we've been under-acquiring, and so acquisitions are back to being far more robust. We've got just gotten, I don't know how to describe it, better execution. I mean, we've recognized this is an issue. We've put more people on it. We're acquiring assets in a more substantial way, and that's really, really important. In addition to our acquisitions coming back, so the sustainable real estate engine is back on, which is really important to us, because as you can see from the earlier slides, the drop off from us that we experienced under COVID has primarily been the sustainable real estate business. So in addition to acquisitions, the selling environment is just really, really good. So it continues to be a situation that is much easier to sell assets than to buy assets. Part of that's driven by replacement costs. So Japan is experiencing very, very substantial construction inflation, order of magnitude 20-30% over the last year. And what that means is, what's the value of an asset? Well, if you can rebuild it at a lower price, then the asset is not as valuable as kind of what the new activity could be. So replacement cost is really, really important. And the reason why real estate tends to go up in value globally is because replacement costs, because other countries have inflation and replacement cost goes up year after year. Japan is not experiencing broad-based inflation, nearly the same as kind of much of the G7. But in the real estate space and construction space, it's been very, very extreme. And so the implication of that is existing buildings are more valuable, and they're a lot more valuable. So we've got all these assets. I pointed to our embedded gains, unrealized gains on our balance sheet. Those have gone up, and the sales environment is really, really very robust. It's getting harder to make economics work, to buy raw land and put up new buildings, because the numbers don't nearly work as well as buying an existing asset. So again, that is very, very positive to us. The other thing is that we're seeing more global activity and investors buying Japanese real estate, and that we expect to see that expanding. I mean, three things are going on with respect to global investors. One, for 2 years, they haven't been allowed to come to Japan. So anybody who wants to do genuine due diligence and look at an asset and have discussions and understand tenants and talk to leasing agents has not been able to come to Japan. So there's in effect pent-up demand as Japan has opened up to business travel again. We have all these real estate investors showing up saying, okay, we want to look at assets. The second thing that's going on is particularly seeing this with Asian-based investors who are taking a view on the yen. The yen is dropped 17% year to date. It was just trading 139. Maybe it has moved since it moves a lot since I started speaking. And so Asian investors who are very familiar with both currency volatility and have certain flight to safety needs in certain cases are finding Japanese assets very, very interesting right now. Despite the fact that they're buying a yen asset and NOI is in yen, they're taking a view that the yen at 139 is very good value. And the third thing that's going on is primarily with US investors. Because the yen has depreciated, if you had, for example, a $300 million budget, you want to do something in Japanese real estate, that's suddenly become 40 billion yen rather than 30 billion yen. So there's a lot more money sloshing around for US investors in order to buy assets. So all as a way of saying We expect to see a significant increase in global activity, certainly with us, and probably more broadly in the Japanese real estate market. Turn to page 25. That speaks to what's going on with Ichigo Owners. Again, to remind you, Ichigo Owners specializes in effectively super prime residential, brand new residential assets, overwhelmingly located in central Tokyo, in certain cases, very prime areas that are also, but it's overwhelmingly in Tokyo. And that business continues to go very, very well. Acquisitions are going well. We expect we're going to do a lot more in this business this year than we did last year. And you'll see some kind of, you know, as is the case every year, you'll see selling activity with substantial capital gains in this business this year. In the first quarter, we made nothing in this business, so that's a way of telling you that more earnings are coming at you. Page 26, we acquired kind of through a rolling kind of acquisition with a full consolidation as a subsidiary. Next year, a company called Cost Science. It's an IT consulting firm. It has significant data analysis capabilities. And it just won a Japanese government DX award, DX being digital transformation. It's working, it's got most of its business is dealing with external clients. It's also working in terms of driving our business forward. There's an example on the page of an actual application where Cost Science, we developed an AI-based demand forecast system that is being used by this incredibly famous sushi restaurant to decrease, loss opportunities, sales opportunities, decrease food wastage, et cetera, et cetera. So we do actually have significant internal capabilities in advanced IT, and as we know, we're deploying them across the firm. And that includes Cost Science. Page 27, we have 3 different listed entities other than 2337, Ichigo Inc. One of them is an office REIT, one of them is a hotel REIT, one of them is Ichigo Green, and we're working to support their growth. On the next page, you can see that acquisition activity is also picking up at the REITs. Ichigo Office is doing an acquisition that closes next quarter. Ichigo Hotel is doing an acquisition that closes next quarter. Yeah, it's interesting. I mean, across the firm, including our REITs, we focus on small and mid-sized assets because it's an inefficient market. We think actually the NOI tends to be far more durable in these assets. They don't kind of go all over the place. They're not bid to the moon and they're not crushed to the earth. They offer really, really good value in terms of high NOI relative to some kind of high cap rates. And they have, it gives you a diversified portfolio. And so the other thing that, of course, it gives you the ability to lean in and use kind of significant capabilities we have as a firm. In small and mid-sized assets, not always the case that you have kind of very capable owners running these assets. So, we're back to acquisitions in both these REITs, and we think, and that was directly linked to kind of the ability to generate higher asset management fees going forward. Turning to page 29 and the clean energy business. It's a business that is continuing to grow very, very well. It's not on the page, but the next step is we're doing local green biomass, and we expect to begin activity on that within the next year. We expect to have 3 new plants online this year, and 2 of them are already online. Page 30 shows our share buyback activity over the last 6 years. We've done buyback 6 years in a row. That is kind of an essential element of our long-term vision, Ichigo 2030. We're going to use share buybacks. If we think that the shares are good value and should be bought in for all of you. We did a buyback this year. To be very, there's no material non-public information here. We expect to continue to be active. That's kind of the statement. That's our capital policy. We think the shares are cheap, and so we expect to be more active. Page 31 just reminds all of you of our J-League shareholder program, which is unique in Japan. We're for our shareholders not only of Ichigo Inc. owners, but also of all of our REITs and our listed solar power producer Ichigo Green, the opportunity to go to J-League games. That is the prepared presentation. Thank you so much. We'll now turn to Q&A. And Greg, you're always first.
Hi, Scott. Can you hear me?
Yes, and thank you so much for always being first.
Thank you very much for presenting. Yeah, my question was regarding the hotel business. So
Yeah.
in the last quarter, we were talking about how the situation, is improving a little bit in terms of the transaction side.
Yeah.
And obviously, this is about 25% of your portfolio.
Yeah.
What are your thoughts regarding kind of monetization for some of those assets going forward?
So that's the one thing that's gone wrong in the last kind of literally 30 days. So I pointed to kind of a structural phenomenon, which is really, really positive for us, which is construction inflation. We're along that. We own all these assets. And our sustainable real estate business is very light on construction activity. I mean, we try to do as little as we can to an asset to improve it. So that's really positive. The one thing that's negative that's happened in the last 30 days is directly COVID related, Greg, which is, at some point, two things have happened. The yen is weakened, and that has meant Japan becomes even more attractive for inbound tourists. And so taking a slightly longer view, to the extent the yen stays weak, that's positive for hotels. But we've had this thing where it's like, COVID is down. Oh, lots of people want to bid for hotels. COVID is up. No, wait a minute. We're gonna stay and watch for a little bit. So, clearly, quite honestly, in the last 30 days, we've seen the slowdown of people like, actually, we're going to wait and see. So I think really what that implies is we've got more volatility. We took a very conservative view on what we would be able to do in hotels because that's kind of who we are. But with some kind of hope that kind of the global and Japan, including Japan, COVID, economic and social reopening would be really good for our hotel assets in terms of the buy-sell activity. At this point, it's hard to say. And it's a way of saying we do need to see kind of a lightening of COVID cases in Japan for us to do a lot of activity. Now, we sold some assets and we'll probably sell some more. But that has been the one disappointment in terms of the activity in the last 3 months is the explosion of COVID cases in Japan.
Understood. Thank you. And maybe a separate question, if I could, on the solar business.
Yeah.
As you've seen, there's been like a take private for one of the, or there is a proposal to take private for one of the listed infrastructure REIT. And there's been, I think, a counter proposal from Canadian Solar.
Yeah.
I mean, generally speaking, are you guys seeing more interest in Japan for those assets? Are these kind of transactions proposal kind of rekindle the appetite for scale in that segment? Thank you.
Well, I mean, broadly, we're kind of operating in, it's a really, really terrible time in the world right now. It's a devastating war and humanitarian crisis in Europe. COVID is still everywhere. Inflation is deeply impacting, people everywhere in the world. The truth of the matter is that the war in Ukraine and inflation are positive for kind of renewable energy assets that are not experiencing. We're not using fossil fuels, so the fact that oil is where it is, or natural gas or LNG are where they are, is not relevant to them. So these assets have become more valuable. And they become more valuable also from a geopolitical and geostrategic perspective, because Japan is, as you know, massively dependent on imported fuels. So trying to do more in Japan is valuable too. So that transaction actually cleared. Canadian Solar lost. We expect there'll be more there, and we think we have a lot of value. Did I answer your question?
Yes, thank you.
Thank you. Happy to take more questions, comments of any sort. Garrett.
Hi, good evening.
Good evening. Thanks so much for joining.
Thank you. So you have the slide that shows the weighted average remaining loan maturity has declined from 9.6 years in fiscal 17 to 6.5 years today.
Yeah.
And given the dramatic increase in interest rates around the world and the threat that this poses to the valuations of low cap rate assets, would you consider significantly extending the duration of your fixed rate borrowings, potentially through the purchase of derivatives?
So we have actually, so thank you, Garrett. That's a super important topic. We actually have macro hedges already on our portfolio to take out interest rate risk, and that's at this point covers over half the portfolio. They've kind of gone down a little bit over the last kind of 6 months. In fact, Dan, I may need your help on this one. What percentage of our total portfolios, if you know, is fixed to this point? And you can jump in if you know the answer. So yeah, I mean, we've taken in, I mean, 6.5 years is plenty long enough. And there's some elements of, we try to be really smart about this. I mean, to the extent that we can borrow for 50 years for free, we'll borrow for 50 years for free. So Garrett, the reason why we pushed it down from 9 to 9.6 to 6.5 over the last number of years is one, because, you know, 6.5 years is literally 6 years longer than our holding period for our Ichigo owners assets. But the other reason to do it is because you get just so much better kind of terms and conditions. People start wrapping all sorts of covenants on you when they go long, when you go longer on that. But you know, if I can read into your question, which is, you know, you should be smart about this and think about doing more. I mean, completely agree with you. And you can count on us to be pretty proactive in trying to take out interest rate risk, covenant risk, you know, diversify our lending pool. All those things are super, and fix up our interest rates. All those things are super, super important. The goal is to make your debt look as much as possible like equity, instead of having an equity capital charge of whatever, you know, is 6% or 7%, 8%. You're running a debt that costs you 90 basis points. It looks a lot like equity. Dan, do you have an answer on percentage that were fixed?
Approximately 52%.
Okay.
Yeah.
Which has come in, and I want to raise that back up.
Okay, and you mentioned like the holding period isn't supposed to be long, but you know, the Bank of Japan now is printing money to peg the interest rate at an artificially low level. You know, it's not impossible that there could be a dramatic rise in, you know, a 6 month period like we've seen here in the rest of the world. And you know, if you're buying a cap rate, you know, an asset with a cap rate at like 2 or 3%, and then interest rates move up like 2% in the 6 month period, it seems like that could be potentially an issue. Yeah,
and Garrett, I mean, again, I completely agree. So and it's worth pointing out that that's part of the reason why we do one, assets. We don't do like super trophy assets. So Garrett, we don't buy assets at 2 to 3% caps.
Okay.
We're generally buying at 4 to 5 right now. So that gives you 300 to generally kind of 300 to 450 basis points cover on your cost of funding, and that's super, super important. So is it, you know, you're exactly right. You know, the problem with people kind of, you know, that in a lot of markets, people fund at 5% to buy assets that cost 3%, and they're like, we're going to make it up on inflation and rental growth. And if it works out that way, great. But if it doesn't work out, then you're underwater and you're going to die. So for us, two things are really important: a significant gap between our funding and the current running yield on the asset. And two, the fact that we add value to it. So what we're doing, Garrett, is we're buying assets that yield 4.5, and we're adding kind of 50 to 100 basis points of yield on top of it. And that also gives you protection against you know, rates going up. Now, the other thing that's worth pointing out is in a rising rate environment, it depends on what's happening with kind of broad inflation and construction inflation in particular. So if rising rates are accompanied with inflation, then we're going to get the benefit of that. You know, the biggest risk is a stagflation risk, or kind of a differential inflation, or effectively kind of interest rate rise only, and it doesn't pass through to kind of the economics of our assets. But yeah, agree with you. This is super important. We're a company that almost died during the Lehman, the GFC, kind of way back then, because we had our rate, our duration of our debt was too short. We were buying at very low cap rates. We were financing higher. We didn't really have a value add capability. It was more, we think we're going to flip to the next company. So we completely reworked the firm, but agreed on your points. This is something we're very careful about, and we'll continue to be so.
All right, thank you.
Thank you. I will wait for a second. Oh, John, thank you very much for joining. Yeah, go ahead.
Hello, hi. Yeah, and thanks for setting up the call. I just have a quick question regarding the buy-sell market. You mentioned that it has come back strongly. In which asset classes are you seeing this positive trend in?
Yeah. Look, residential's extraordinarily strong. And that's quarter of our assets. Retail is also doing well. Hotels continue to be deeply impacted, but in general, the phenomenon that we're experiencing is kind of significant. It's a seller's market, continues to be a seller's market, but the obvious one that we're involved in, logistics, is kind of the supply-demand situation we're not very involved in, has loosened. It's still kind of more demand than supply, but a lot of supply coming on. So that market is kind of slowed down somewhat in terms of buy-sell activity, and certainly kind of the massive bid for logistic assets. But the really obvious one is resi. Japan has protected, wage incomes very well. There's a labor shortage, wages are going up. And so, residential is just a very durable asset. And in the world, and so in Japan, to the point this raised by Garrett, Japan, the BOJ, the other thing that's happened in the last 3 months is the BOJ has doubled down on, we have an inflation outlook we don't think is durable. This is temporary. Japan is not broken out of deflation, and so the BOJ has doubled down on staying loose. I mean, in that context, I'm trying to own an asset with a decent yield is important. And the other thing we see is a lot of the global investors are interested in resi and residential also. It's just a nice, it's durable Japanese asset with an obvious economic stream attached to it. So resi is really well bid.
Understood. And in the current environment, just in case anything was to change, say if the Bank of Japan was to let yields rise, do you see a need to accelerate your sell activity before that window of opportunity closes? And in that regard, if we look at your targets for the sustainable real estate, at what point within that range do you expect us to fall in by the end of the fiscal year?
Oh, well, I mean, we're very comfortable. We're gonna hit our numbers, and that's because we have visibility on our transactions. I mean, look, the way we think about the world is we're not in prediction business. So we're not people like, oh, the end's 139. We think it's going back to 115, or the end's going to 159. I mean, maybe. What we do is we run scenarios around kind of what could happen. The yen could go 160. The yen could go 100. And by the way, the yen movement is since we're effectively a domestic firm, isn't super relevant to us. Although, as I pointed out, there are some knock-on effects. It appears to be the case that the weak yen is making it attractive for certain global investors are finding yen more attractive. So the real issue is the one that Garrett just pointed to, which is interest rates, and how do interest rates interact with the NOIs on our assets. And that's why we have, run with kind of long-term debt fixed, very effectively no covenants to speak of. And that's really important to us. And keeping over half of our debt fixed. And in fact, we really target something that looks more like 70% of our debt being fixed is important to us. So we've gotten a little bit light on that, and we want to push it back up. But yeah, I mean, if rates go to 3%, they go to 3%. That's what's so important about having a margin of safety. We are, if it may be out of favor, but we are value guys. And so, the issue with owning, assets that yield 4% and you're funding at 3%, if rates go up, if rates double, if they go up 300 basis points, you've just become 200 basis points underwater. And when you own assets that you buy at 4.5, and you're funding at 80 basis points, rates go up 300 basis points, which is a massive move, right? And you're still covering. You're making less money, and so that's really, really important to us to maintain the big buffer between where we fund and where we yield, and also to be able to add value on top of that. So again, to read the point, generally we add 1,500 basis points worth of NOI on any asset that we buy. Did I answer your question?
Yeah, that answers my question. Thank you.
Thank you.
And sorry, final question will be around
Sure.
Odaiba.
Yeah.
Did you mention like current occupancy rate that this is currently at, and the progress that you're making with regards to the leasing of this asset?
Yeah, it's occupancy is about 56-57% right now. And Odaiba sort of drives us nuts. It's the only big office we own, big enough to matter. And it was a special case, Olympic venue, all that sort of thing. Made, we've done perfectly well on it in terms of against the business plan, all that sort of thing. But there were lots of things that were possibly going to happen in terms of the Olympics enhancing the value of the area and giving it attention, and we would be able to sell into it or after it or something like that. And of course, we had COVID and no Olympics, so it's like, okay, that didn't work out. But it is a really striking statement about how large-scale office is really under pressure. And as I understand, it's under pressure globally. It's under pressure as far as we can tell in Japan. This is not big data, this is small data. We only have one big asset, one big office asset. But it's, our small and mid-sized offices are doing great, and we're keeping them. And it appears to be a function of better value, lower cost per tsubo, but also just kind of smaller companies being more diversified and more wanting to be in the office of peers and larger companies. But anyway, so Odaiba is currently at 56-57%. We targeted getting it to 80% if we can this year. I don't know. That may be hard to do. Because we're seeing continuing pressure on other large office assets. So we've actually started work on doing a fairly substantial repositioning of the asset away from large companies towards more venture sorts of companies. And by the way, not kind of like crypto startups, as I said, we're conservative people, but companies that are smaller, have robust businesses, and actually looking at creating kind of a community in that area. So it's a big enough building that you could actually do some things that are interesting with kind of the neighborhood, as it were. And so we're looking hard at that. But Odaiba is, as I said, 56-57%. I expect that end year our occupancy will be higher than that. Don't know if it's going to be as high as we want it to be. We'll just have to see how kind of the next kind of 6 months of leasing activity works.
Awesome. Thank you.
Thank you. All right. We will declare ourselves done. Thank you so much, everybody. We're really grateful for your time. We know it's busy and it's a tough time of the world. Everybody take care, be safe, have a very good day. Thanks so much.